Yes, let's watch it together at the Fed's closing time. I'm Lee Ji Go. Today, at this hour, let's hear in detail about what the Fed is talking about. Reporter Yang Bin. Hello, reporter. Yes.
Hello.
Yes, we have an important issue for you today. I heard that you will give us a sense of the market sentiment regarding the Fed's easing of the SLR regulation. Let's check the topic and go. What is the SL regulation and what is its market impact? We will talk with Economy 21 reporter Yang Hyun Bin today. Reporter, I'm curious. I think many people are wondering about this SL regulation. I heard that the SLR regulation is sometimes loosened and sometimes tightened depending on the market sentiment. I heard that it is also connected to the government bond part. What is this SLR regulation?
Yes. The SLR regulation came into being in 2008, when the financial crisis began, and financial experts all over the world thought that we had neglected banks too much in order to prepare for the financial crisis. So we had to regulate them a bit, and they came up with a new regulation and managed them very tightly. There are two main things to regulate banks. One is liquidity management. This is because banks may have balance sheets and are fine, but banks are companies that receive deposits, make loans, and make payments. So, yes.
Deposits can suddenly disappear today or something like that. In fact, the U.S. banking crisis in March 2023 was
fine because the banks themselves were fine. For example, if the banks held government bonds or something like that until maturity, there was no problem. But suddenly, people hear rumors or the company seems a little risky, and there's a
crisis, and that's
actually, strictly speaking, a liquidity issue. So, if a bank suddenly has customers withdrawing their deposits, there's a liquidity regulation that responds to that liquidity. That's usually called LCR. It's LCR. It's not the one we're talking about today, but SLR. SLR is a measure of a bank's debt ceiling capacity rather than liquidity. Liquidity was the solvency, and it looks at how much solvency a bank has.
It controls areas where finances themselves can become a problem.
Yes, that's right. If a crisis comes, the price of a bank's assets can fall. The bank's liabilities are deposits, and those don't fall. There are always assets and liabilities. Liabilities have fixed prices.
In the case of assets, the price may go up and that makes you
feel good, but sometimes the price may fall. Then you feel really bad. It's not just that you feel bad. Isn't the bank itself experiencing capital erosion? The market can see this. Then, what should the bank do in that case? Of the assets it has, not all of them will fall in price. For example, if the bank had stocks, which are prohibited, but the stock price went up to $100 and then fell to $50, then the bank's soundness was in question. In that case, what should the bank do? Among the assets it has, there must be some whose price doesn't change much. Whether you sell that or not, if that's not enough, what do? Equity capital means not just stocks issued by the bank, but also deposits and reserves. You can use that to make up for it. So the SLR regulation is not about looking at the debt side of the bank, such as when depositors withdraw money, but rather when asset prices suddenly plummet on the asset side of the bank. How do you resolve that? In a way, it's related to the bank's ability to manage its debt situation. This is called Bar 3, and this contract was managed very tightly at 3%. But the US was actually at the epicenter of the 2008 financial crisis. So what if the US regulated countries did, like our important banks in the US, for example, the Bank of America, JP Morgan, you guys are very important, but if you did that, the whole world would be shocked, so you did 3% in the third, but you specifically did it at 5%. So you have that much more capital. That's what they did. Then, at the Fed meeting on the 26th, it passed with a vote of 5-2. Well, it's not completely over yet. There's other things too. There are other monetary authorities, so I expect that to happen, but it's probably going to be almost like this. They lowered the rate from 5% to 3.5%. Yes.
So it looks like a big lowering, but in reality, it's a bit low at 3%, so they lowered it while maintaining financial soundness.
Right, yes. So now senior and now there are two major bank regulations, and people often talk about them in confusion, but one is related to assets, which is SLR, and one is related to bank liabilities, which is LCR, and it's related to liquidity.
Okay, these two methods of regulating banks are largely divided into SL and LCR. This time, the Fed adjusted the SLR from 5% to 3.5%. So what will actually change in the banking sector if this ratio changes?
Okay. This is the bank's balance sheet on the left. It's the left and the right. The left is the previous one. The previous SLR was 5%. That is, equity divided by total asset size, which is 5%. So if you look at the left here, equity is 5. Next, the size of assets should be equal to the size of liabilities, so it's not 100. So 5 or 100 is 5%. But this is 3.5%. So what if the bank assumes that its equity capital remains the same and increases its assets to a certain extent? This makes it 3.5%, so it's roughly 140. Here, it's easy to calculate only about 140. Yes.
So, in the area where changes can occur in the banking industry, there may be some changes in the asset ratio. But I heard that what is actually being discussed in the market is that it has a lot to do with government bonds. What kind of connection is there?
Yes. If you do the SLR ratio decreases, so the bank can increase its assets, and among those assets, government bonds are included. Banks hold government bonds, reserves, and MBS, and most of them now have the largest debt. So, can they do that here? Then, will they only increase government bonds?
No. Why? If banks say,
for example, a 10-year government bond, the expected yield is 4%. Yes. But if they make a loan, the expected yield is 10%. So, what the bank does is, they evaluate the expected yield and the risk of not being able to repay the loan. Based on that comprehensive judgment, they
decide whether to invest in government bonds, MBS, or loans.
This time, they lowered the yield from 5% to 3.5%, so they won't invest all of it in government bonds. Then, as usual, since the SR ratio is low, banks have more incentives to invest in long-term government bonds. Yes, there is an incentive, but if we compare it to past experiences, I think we can find some answers.
Yes, there was a time when SLR regulations were relaxed like this, even during the COVID-19 pandemic. So, if we compare it to the COVID-19 situation and look at what happened then, it would be good.
Yes. This is the second time that the senior SLR regulation has been changed. There was also a temporary exemption during the COVID-19 pandemic. There was a temporary exemption from April 1, 2020 to the end of March 2021, but it is actually a bit different from the current one.
The current one is lowering the total ratio from 5% to 3.5%. But at that time, 5% was maintained as it was. Oh.
Then what was done at that time? At that time, it was a temporary exemption. So if you calculate the SLR, it was the bank's assets under equity capital. As you can see here, this is the bank's lending and borrowing treatment. But what is subtracted from assets? It is reserves and government bonds.
Oh.
That was done temporarily during the corona period.
Yes.
Then, in this case, if you calculate the SR, it is capital divided by assets, and the
capital remains 5.
But since the assets are reserves and government bonds, the assets decrease. The
denominator decreases. Yes, that means the bank's SL ratio
goes up to 6.25%. Then, the bank can do something with it, such as lending money or buying government bonds. So, back then, the SLR was kept at 5%, and
now it has been lowered from 5% to 3.5%. At that time, instead, when calculating the SLR, the denominator included government bonds. The reason for this was that there was a huge crisis in the market for government bonds and government bonds. Even when there was a financial crisis or a crisis like Corona, the
price did not fall. It remained the same. Rather, the control reserves were
tightly adjusted
so that the Fed guaranteed it, and government bonds were guaranteed by the U.S. Treasury. So in fact, the price change was not that big. In fact, the price of government bonds went up during a crisis.
Because people wanted it. So, seeing it as a risky asset, going into the market, this is a bit, logically flawed. So many experts made the request, and the Fed accepted it and said, oh, since we're in a crisis, let's calculate it as 5. Now, it's gone up to 6.25. Then, the Fed, the banks could have used that too. Lend more or do various things to overcome the crisis.
Yes. So there must be a clear difference between the temporary exemption of SLR during COVID and the adjustment of the ratio itself. But I think it's not easy to calculate. Could you explain what is clearly different this time compared to COVID?
Yes. Then, if you look at the next chart, during COVID, the SR, the SLR, the composition, the payment reserve bonds, you know. So here, this is an extreme case. If this is possible, then
this is the left side before the temporary measure in the SLR. Then it was originally 5%, but it was 5 or 100, and then the government bond yield went from 5 or 80 to 6.25%. Now, if the bank thinks that government bonds are really good and increases the government bond yield by 10, then what happens to the SLR? It's
the government bond and the reserve requirement.
Yes, there's still no change.
Then the SLR value is still 5 or 80 to 6.25, so this means that theoretically, the bank can purchase government bonds indefinitely. Why is that not included in the denominator when calculating SR? Then what will be the impact on the market? It's not like you can buy government bonds infinitely like this. There are other LCR regulations, so there is an incentive to buy a lot of government bonds. But if a bank buys MBS or a company or lends a lot, the SL and LR will gradually fall. That's because the assets that go into the calculated value go up. But in this case, when you buy government bonds, this doesn't go in, so the SL value stays the same. So why did you do this? The Fed did a huge QE during COVID. The Fed didn't just do QE, but the Treasury also issued a huge amount of government bonds. So who has to receive this? After receiving the performance, they said, since the Fed isn't enough, why don't you lend some money to the banks and commercial banks? But anyway, the temporary exemption from the SLR during the COVID-19 pandemic was focused on acquiring government bonds.
So I wonder if this was actually applied. In theory, the SLR itself says that the central bank can purchase an unlimited amount of government bonds, but I wonder if the banks actually implemented this. Do you think the banks actually bought a lot of government bonds? If you look at the next chart, this shows the flow of assets that go into the denominator when calculating the SLR for large banks. And there's a function in the middle. There's a red circle. This is when they give a temporary exemption. If this is the case, the one at the top is JP Morgan, the largest bank in the US. The
assets suddenly fall. That's because they calculate it by taking into account the reserves and treasury bonds. So the size of the assets themselves is constant, but they go up little by little. That's the asset that is calculated from the SLR. In the denominator, the reserves and treasury bonds are given, so it's natural. And as soon as that ends, the flow is also very, very small. If you connect the starting point and the end point, what do you think? It's almost gone up a little bit, right? And now you can see it going up again. Well, that's because the Fed clearly said at the time that this was temporary. It was for a year. In the meantime,
it shows that the banks just didn't buy a ton of government bonds. Why is this a one-year bond? Yes, we don't
know what will happen to the one-year bond. They did buy government bonds, but because it was a temporary measure, we can see that their assets decreased. Then what happened to their equity capital? The banks worked hard to make money. So if you look at the next chart, you can see that their equity capital is going up little by little. So the numerator increased and the denominator decreased. So what happens to the SLR? It's going to go up. That's the last chart.
Then the next chart. If you look here, the banks, the next chart, please. We can see that the bank's SLR ratios are going up. Oh, yes, it's coming out here now. The SR ratio is definitely going up. In that case, of course, the denominator decreased and the numerator increased, so we can confirm from past experience that these things happened.
Yes. Certainly, the exclusion of gold and government bonds from the SL exemption during the Corona period seems to have been a strong incentive. However, the actual effect of the government bond purchase was not as great as we thought. They say it is because it was a temporary measure, but this time, the conclusion is a bit different. Then, what is the outlook for the impact on banks going forward?
Yes. First, let me briefly explain that at that time. In a way, banks were focused on acquiring government bonds during the SLR temporary exemption period, and it was a policy to induce banks to acquire government bonds. Then, how much did it cost then? Now, if we compare it to now, we can see how it will be now. This is the black one at the top.
This is the amount of government bonds issued by the Treasury. So we can see that it has gone up significantly during the Corona period. And the orange one in the middle is the amount that the Fed acquired. Since we're looking at this level, the movement doesn't seem to be that big. The blue one at the bottom is
what the bank acquired. Do you see this? You can barely see this?
Okay, let's zoom in on this one more time. When we zoom in, this time, if we draw the chart, we'll set January 1st, 2020 to 0. So now we can see how much it has increased compared to January 1st, 2020.
Then, if you
look at the banks here in blue, they're going up very slowly. Then the performance is going up very sharply. Then, overseas and the American private sector, in the middle here in black, you can see that they're buying a lot too. Then, if you look at this too, it seems very small. In fact, it's very small. To see the specific numbers, I'll draw only the banks separately at the end. This is what the banks purchased in January 2020. It's just the amount of government bonds. It's 0.37. How much is it? No, $370 billion. Yes, $370 billion. So that's based on $1 trillion. From January 2020 until the temporary exemption ended, they purchased $370 billion. Well, it's not that much. If you want to see how much the banks actually bought at that time, you can compare it to how much government bonds were issued at that time. The net government bonds issued at that time were $4.81 trillion. So, how much is 0.37? So, it was roughly 7.6%. And if you look at that, it's
a very disappointing number. This is when I was young, so compared to what the Fed intended and what the Treasury did, it wasn't
as effective. The effect wasn't great, and why was that? If you look at it, it was a very temporary measure, so it had limitations.
Yes. Next, from the bank's perspective, the
bank has to consider how to manage its asset portfolio to see how much return it will give it, and
then there's the assessment of whether the asset is safe or not, and there's a risk assessment. They make a comprehensive judgment on all of that, and out of that, the bank's government bonds are just one of them. The Fed was very ambitious in saying that they would exempt you from the SLR, so they could have actually bought a lot of government bonds, but the fact that they only took that much means that even if the conditions are good, banks consider returnability and stability when forming their portfolio, so I don't think they'll suddenly buy a lot of government bonds just because the SLR regulation is gone.
Yes, it seems like the Fed was disappointed once. That's why I think they've eased the regulations in a completely different direction from that temporary structure this time. So do you expect that there will be some results from the government bond purchases this time?
yes, let's take a look at the next chart. This only looks at large US banks, but in fact, we looked at all banks in the US earlier. In fact, almost all of the corresponding banks are US banks. The flow is almost the same. Then, there's the number 378 in the middle, right? This is based on $1 billion, so it's almost the same as before. This is the amount of government bonds that large banks purchased when the SR regulation was temporarily suspended. And then in the middle, it says 720 again. They purchased almost that much again. That is, even though there is no SLR regulation, and even though there is
no SL exemption, and even though there's still an SLR regulation, they are
purchasing more internationally. Yes, if you look at it in almost the same period, they purchased almost the same amount. That is, whether or
not the SLR regulation is lifted, banks still just think, oh, I should hold this treasury bond, and they hold it in their overall portfolio. Oh, the regulation was lifted. The regulation was strict, so they didn't buy or sell treasury bonds because of that. That's how I see it. Then why did the Fed change the rate from 5% to 3.5% this time? I'm curious about that now. The fact is, the Fed is hoping that the treasury market will stabilize, but what's of greater concern to the Fed is what kind of crisis will occur? Then, we don't want the 2023 financial banking crisis or the 2020 COVID-19 crisis to happen again. So, when a crisis occurs, banks need to have some weapons to respond. What we've done so far is, if a problem arises, they can come to me and I'll
give them money, and we created a repo facility called the Sanxio. We did that. And
what we did next this time is, if you say the 5% regulation is too high, we'll lower it. Unlike 2020, we won't add anything to the denominator or anything like that. We'll just lower the total from 5 to 3.5, so if a crisis occurs.
We'll provide that much crisis management capability, so they can handle it well. Banks also like this. Banks, as we saw in the past 2020, when the SLR fell from 5% to 3.5%, banks were able to move in their own way. Then, they could increase the denominator, buy international bonds, lend more, or do other things, but they could also reduce the numerator. The numerator is equity capital. How do you reduce equity capital? You do a
buyback. From the bank's perspective, the Fed has been doing a lot of buybacks, while the monetary authorities have been saying, don't do this.
So now, the path is open for bank buybacks. So, they reduce the numerator. So, the banks and the Fed are having a good time. Just because the SR regulation is lowered from 5% to 3.5%, it won't just lead to a purchase of government bonds. That's how I see it.
Yes. In terms of the liberalization of banks' operating capabilities, it will have a positive effect on their stock prices. However, as the market is talking about, based on past cases, I hope we can check that it is not entirely positive whether the effect of this government bond purchase will really increase significantly. Today, we were able to hear various contents with reporter Young Hyun Bin during this Fed Watcher time. Thank you, reporter. Yes.
Thank you. Yes, we
will learn about the issue with the reporter today. I hope it will help you in your investment decisions. We are taking a break over the weekend. We will meet next Monday. Thank you, everyone, for watching.